Your behavior with money is more important than how much information you know about managing your finances. Hi, welcome to the Self-Up. This time, I will discuss the book Psychology of Money by Morgan Housel. This book discusses how humans relate to money from the perspective of human behavior. How you use money well comes not from what you know, but how you behave about money. We're taught that investing, personal finance planning and business decisions are all about math, where data and formulas tell us what to do. The reality is quite different. The majority of people don't make financial decisions based on reports. Instead, they make those decisions at the dinner table or in the meeting room, where all the emotions are mixed, from pride, greed, our view of the world, and so on. In this book, Morgan will write 19 short stories that explain the strange way people think about money and teach you about money itself. I've summarized them into 3 key takeaways from the book. First, managing money doesn't have to be smart. A genius who loses composure in managing their finances will be fatal. On the contrary, an ordinary person with no financial background can become rich if he or she has certain behavioral traits about money. This has nothing to do with intelligence. There is an interesting example. Ronald James Reed was a gas station janitor and donor in the United States. Ronald lived a simple life, saved regularly, and by the end of his life, he was able to accumulate $8 million. The majority of his wealth was donated to local hospitals and libraries. The second story is from a man named Richard Fuson. He was a Harvard graduate and executive at an investment management firm called Merrill Lynch. Throughout his life, he was heavily in debt and lived very extravagantly. Until finally, bad luck arrived during the 2008 financial crisis. This event forced Richard to declare bankruptcy. The difference in the fate of these two people is not due to the intellectual level of a person, but based on how they behave about money. Ronald lives simply and manages his money well, while Richard lives lavishly and extravagantly. Financial success is not a rigid science, but rather a soft skill where your money behavior is more important than how much you know about money. The experience we have had up to this point has greatly influenced our judgment about money. Here's an interesting example. People born in the 1950s and 1970s have different views on the US stock market. For people born in the 1950s, they experienced firsthand how small the returns from the stock market were in the 1960s and 1970s. Because at that time, the average return was only 1 digit. Meanwhile, people born in the 1970s had a different perception. They saw the stock market on the rise in the 1980s and 1990s. This is what makes people born in the 1970s have a more positive perception of the stock market than people born in the 1950s. This example proves that we cannot forget the importance of one's personal experience in making a decision. Second, a unique fact about money. There's an interesting story between 2 writers, Kurt Vonnegut and Joseph Heller, who were at a billionaire's party. Kurt told Joseph that the billionaire's income in one day was greater than Joseph's entire income from his most popular novel. Joseph replied that he did, but he had something that the billionaire couldn't possibly have, which was the feeling of being enough. We have a habit of comparing ourselves to others. This is a never-ending process and there will always be someone above us. It's like saying, there's still sky above the sky. Most importantly, we must know what it feels like to be enough. This means that we avoid doing things that we regret in the end. For example, take the story of Bernie Madoff. He was convicted of the biggest Ponzi scheme in history. A scam that lasted 17 years and involved thousands of investors with billions of dollars worth of investments. This is an example of a case where someone didn't know enough. They brought themselves to the brink because they were greedy and didn't know when to stop. We need to understand that many things in the world are not worth the risk. For example, in the pursuit of wealth, we run the risk of losing our reputation, freedom, friends, family, and so on. Another unique fact, wealth is something you don't see. For example, when someone drives a car that costs $1 billion, he might be rich. But the fact that you know about his wealth is that he has spent $1 billion to buy a car. Morgan reminds us that actually, When people say they want to be billionaires, what they really mean is that they want to spend billions. Simply put, they want a glamorous lifestyle. However, that logic is at odds with being a billionaire. Morgan gives an example that there is a fundamental difference between wealth and rich. The two words are not the same, there is a fundamental difference between the two. Rich is a person who lives in a big house and drives a luxury car. People with large incomes are rich. They show that they are rich, but wealth is different. Wealth is hidden. Wealth is income that is saved, not spent. So, what we actually see is rich, not wealth. There may be people who look rich, but actually have a lot of debt. But there are also people who have a lot of wealth, but they look ordinary, they don't look rich. Third, maintaining wealth is not the same as building wealth. There are many ways to acquire wealth, but according to Morgan, only one way to stay wealthy is a combination of living simply and having fear. Acquiring wealth and maintaining wealth have different approaches. In acquiring wealth, you need to take risks and be optimistic. Whereas in maintaining wealth, you need a mindset that is 180 degrees opposite, which is to live more simply, and fear that what we have accumulated over the years can be lost in an instant. That is why we must have a survival mindset in order to maintain wealth. First, solid financial condition. We must have good money management. For example, how much for conservative investment and how much for aggressive investment. This division must be clear and well observed. This is so that we are able to enjoy a good financial condition in the long run. Secondly, our plans may not happen. A good plan should leave room for failure. This means that we must be ready with a second option if the first option does not work. A venture capitalist named Michael Moritz once said that we cannot assume that tomorrow will be like yesterday. And we also can't assume that yesterday's success will generate wealth in the future. Third, optimistic but also afraid. Maybe for some people this is quite confusing. But the essence is, we should be optimistic about the future, but we can feel paranoid about the obstacles we face on the way there. Of course, this emphasizes that you should always be cautious and vigilant in defending your wealth. There's a simple fact that people rarely understand about Warren Buffett's wealth. Not only is he a great investor, but he's been a great investor for over 75 years. This is his secret. Warren's financial success doesn't come from seeking the highest possible return. But, how can you get relatively good returns over a long period of time? This is what ultimately makes the compound effect roll off the tongue and the mindset we should have when accumulating wealth. You can build wealth without a big income, but you can't build wealth without the right mindset about money. Please comment in the comment section what lessons you learned from reading this book. If there are any other books you'd like me to review, let me know in the comments. Don't forget to like, share, and subscribe to the Self Up YouTube channel. Thanks for watching, and see you next time.